It's Friday, 20th of September, and this is your Capital Economics Weekly Briefing. I'm David Wilder, and I'm joined once again by Group Chief Economist Neil Shearing to run through what has been a pivotal week in global macro. Hi, Neil.
Hi, David.
Well, that's it then. Fed easing has begun. I guess we can all go home now, except that the debate about how much the Fed will start cutting rates has shifted, hasn't it? So we've gone from 25, 50, that's all dead now. It's now, where will this easing cycle end and how long will it take to get there? And I thought we could start by running through some of the questions that we had in this client briefing that we held yesterday. So that's Thursday. We do these drop-ins. They are short 20-minute online Q&A sessions with clients. We do them regularly. And yesterday's questions, if you run through them, they could be bucketed into short and medium-term risks. And the short-term risk questions are really about whether inflation could resurge. You know, is the inflation genie really getting back into the bottle, or will central banks have to reverse ferret on their rate cuts, particularly if you talk about the Fed, given how much it has started easing by?
Yes, that's a critical question. As you say, we get asked it a lot. I mean, our view is there's clearly risks to the inflation outlook. It's not difficult to imagine how you could get a resurgence in inflation if, for example, the US election went one way and we got a raft of tariffs imposed in early 2025. That would clearly be inflationary, as would some of the measures that Trump is talking about with respect to the US labour market and immigration. However, I think when you look across the data, our sense is that, at least as far as the US is concerned, inflation is done. So absent a new shock on the policy front, I think inflation in the US is done. Shelter inflation is the last part of the puzzle. And if you look at the new rental indices, those are suggesting that shelter inflation should start to fall over the coming months. Slightly more complicated picture in Europe, I think it's fair to say, because labour markets are tighter. And if you look at some of the pay rounds, particularly in the UK, they're still not really consistent with 2% inflation targets. And of course, Europe, including the UK, has much weaker rates of underlying productivity growth. So some lingering risks in the UK, but I think the same framework for thinking applies across advanced economies really in the post-COVID world, which is principally about how the supply side of economies heal themselves rather than crushing demand. And clearly demand's been inflated by loose monetary and fiscal policy. We don't necessarily need to crush that if you get some supply side repair coming through as the disruptions from the pandemic continue to fade. And I think that will continue to play through in Europe. Also worth noting that some of the weakness of growth in Europe is structural rather than cyclical. That's particularly the case in Germany, so not necessarily associated with weaker inflation. Put all that together, and I think inflation is done to a large extent in the US. It will soon be done, I think, to a large extent in Europe. And so easing cycles have further to run.
I mean, 50 basis points notwithstanding, though, it doesn't sound like, I mean, even the Fed, it doesn't sound like they're in a terrible hurry to unwind policy, to slash rates.
Yeah, it was a pretty hawkish 50 basis point cut, wasn't it? Both the dot plots, but also Powell's remarks in the press conference. And subsequent to the Fed meeting, of course, we've had the Bank of England meeting. They made it clear that they were in no rush to follow the Fed with jumbo-sized rate cuts either. So I think particularly in Europe, we're going to get central banks going pretty slowly. So we have the ECB kind of 125 basis point cut per quarter. We've got the Bank of England cutting again this year, but in 25 basis point increments rather than 50 bips that the Fed started with. And even in the case of the Fed, actually, we suspect that they will slow the pace of easing from 50 basis point moves to 25 basis point moves over the coming months and quarters. So perhaps one way of thinking about the Fed's decision was that it was perhaps a tacit acknowledgement that they should have gone in July. They didn't, of course. They waited, and then the data have started to soften, and so they're trying to catch up and make up for the fact that they should have cut in July. That's one way of reading it, and then you get a kind of resumption of a more normal 25 basis point rate cutting cycle.
Yeah, I guess that highlights this issue of data dependency that you've been talking about on this podcast. I mean, also, it's just worth bearing in mind that Kashkari was talking about raising rates as recently as May, which I think tells us how this narrative has shifted.
Completely. The narrative's been turned on its head. I mean, Bill Dudley wrote several pieces for Bloomberg calling for a 50 basis point cut over the past few weeks, but it was this. He was talking about having to raise rates as recently as kind of May, June as well, I think. So there's been a lot of reverse ferreting, to use the technical term, amongst US policymakers and former policymakers over the past few months. I mean, for what it's worth, we started the year saying that we thought the Fed should be cutting in around May time. So they're late starting from our perspective anyway. So the fact they're now moving in 50 basis point steps perhaps just makes up for a bit of lost time. But yeah, as I say, I think we're now in a 25 basis point move territory rather than successive 50s.
Let's get off ferrets, but stay on central bankers, because the other big question that came out of that briefing on Thursday was about where rates will settle over the medium term. And you mentioned Powell's presser. He did say, and I'm quoting, he said, "It feels to me that the neutral rate is probably significantly higher than it was before the pandemic." What's your take on that?
Yes, he's referring here, of course, to R star, which is the real equilibrium interest rate. The idea that is that the real interest rate at which the economy, at which policy settings are essentially neutral. It's a really useful framework for thinking about whether policy is restrictive, whether it's accommodative. However, it's inherently unobservable. So it's not a particularly useful way to anchor policy. So a useful framework for thinking, but not necessarily an effective anchor for policy. Now, what's happened to R star? Powell's view is it's gone up significantly. We produced a major piece of analysis about this time last year, looking at shifts in R star. Our conclusion was it has gone up compared to levels prior to the pandemic, but I'm not sure it's gone up significantly. For what it's worth, we thought that R star before the pandemic in the US was about 0.5%. So 0.5% real, add on your 2% inflation, the neutral nominal rate's about 2.5%. Now we think that might be closer to 1%, so maybe a bit over 1%. So again, add on 2% inflation, you get to a neutral nominal rate of 3.25%, something like that. And the reason for that is that some of the forces that were pulling down the neutral rate prior to the pandemic, in particular, some of the forces suppressing demand in the wake of the global financial crisis, have effectively eased, and fiscal policy is a lot looser too. So that's tended to push up R star. Looking ahead, I think the key point that's perhaps been missed is not just what's happened to R star since the pandemic, but also what's going to continue to happen to R star over the coming years. And if we're right in thinking that productivity growth, particularly in the US, is going to accelerate on the back of the rollout of generative AI, then R star will continue to ratchet higher. So it's about 1% now. We think it could get to as high as kind of 1.5%, 1.75% by the end of this decade. So neutral nominal rates would then be touching 4%.
You talked about the uncertainty around policy making using R star as an anchor. And actually, to Powell's credit, he has talked before about how it's like navigating by the stars on a cloudy night. But what are the real world implications of this idea that R star is higher now than it was before the pandemic? How does that feed into where US rates and actually how quickly US rates should get there?
Yeah, I mean, it's pretty simple, really, which is that if you believe that R star is 50 basis points higher than it was before the pandemic, then the neutral policy settings have also gone up by 50 basis points. So, for a given level of inflation, you want nominal rates to be about 50 basis points higher. So if we're thinking about average interest rates over the cycle, they should be about 50 basis points higher over the coming cycle than they were over the past cycle in real terms. And obviously inflation has been higher too. So in nominal terms, they're going to be higher still. So this is why it's a useful framework for thinking, because it helps you to analyze where you think policy might be restrictive or accommodative. The issue, as you say, as Powell says, it's like navigating using the stars on a cloudy night. It's really difficult to pin down. So useful framework for thinking, quite difficult to implement in practice.
And it's important to note, you mentioned that big work that the team produced last year on R star, and I'll add that to the podcast notes. But it's important to note, isn't it, that this isn't just a US issue, that we think that R star or these equilibrium real rates across developed markets are higher than they were. So that applies as well to the Bank of England. It applies to the European Central Bank as well, right?
Exactly, yeah. So R star, we think, has probably crept up in most of the major advanced economies, again, by a similar amount, 50 basis points or so, and it will continue to creep higher. However, the neutral interest rate is higher in the US than it is in the Eurozone, reflecting the fact that trend rates of growth, potential rates of growth in the US are higher too. So neutral rates have gone up everywhere, but they're higher in the US than they are in Europe. So I mentioned that we thought R-star, the real neutral rate, might be about 1% in the US. It's probably about 0.5% or so in the Eurozone.
Before you go, I want to stay on that issue of different paces of trend growth, because our Europe team this week has been warning about another German recession. That'll be the second in 2 years, albeit a technical one. But you've also got China, whose economy seems to be mostly firing these days on selling things to the rest of the world. What does it say about the state of global growth that the US still seems to be the only game in town in terms of the contribution of these major economies?
Well, this is an area where economists tend to get themselves tangled in knots. So they'll look at GDP growth in different countries and they will then weight it by the size of those economies and put it together and get a number for global GDP growth and say, well, China contributed X% of global GDP over the last 5 years. I think a better way to look at this in terms of the sustainability of global growth is to look at where the final demand is coming from. And when you look at it through this lens, the global economy is becoming increasingly unbalanced and in particular, especially reliant on US final demand. So you mentioned China's economy. It's a strange mix at the moment, China's economy, of an extremely weak domestic economy, not just because of the problems in the property sector, but weak consumption, but an export sector that seems to be firing on all cylinders. Export volumes likely to hit a record high in China this year. The problem is that someone's got to consume that output and it's being shipped to the US. And so when we look at China's current account surplus as a share of global GDP, that's close to a record high now. The final demand is in the US. So the world is becoming increasingly reliant on the continued health of US consumers. Now, there's a few cracks at the bottom of the income distribution emerging among US households. That's worth keeping an eye on. But in general, we think the US consumer's in reasonable health. However, there's a big risk lurking in the background here, which is at some point, I think Western policymakers are going to push back against China. This is not 2005, which was the last time that China's current account surplus hit this share of global GDP. Back then, the world was globalizing, the future was multilateralism, global leaders believed in comparative advantage, and that globalization meant that you get a smaller share of a bigger pie. We're in a very different world now. And if we're going to a world where China's surplus is rebounding and the US deficit is rebounding too, then I think quite quickly we're going to get pushback against that, no matter who is in the White House. So I think this is perhaps one of the biggest issues facing the global economy over the next 2 or 3 years.
Neil Shearing on the US, China, and an increasingly imbalanced global economy. Our global team had a report out on this theme a few weeks ago. I will add that to the podcast notes along with the R-star work that Neil and I discussed. That work on imbalance is a really useful way of looking at how the global economy is likely to evolve, and not necessarily for the better as this breakdown in US-China economic relations develops. On China, in case you missed it, we've just cut our GDP growth forecast. I will add the report explaining why to the notes. Our China activity proxy will be updated in the coming days, so watch out for that monthly refresh for the latest independent look at what's happening in the Chinese economy. I also mentioned Europe. Our quarterly Europe economic outlook has just been published. It talks about a German recession, though stagnation is the more accurate way of describing it. The Europe team is holding a drop-in on Tuesday to talk about what's going wrong and to answer your questions. I will link to the event in the notes so you can register and get your questions in. There's another Europe event on Wednesday. That's the 25th of September. That's about the size and strength of the recovery in European commercial real estate. So sign up for that as well. I'll put that in the podcast notes. As with all our events, if the timing doesn't work for you, register anyway, and we will send you an email of the recording as soon as the event has concluded. Now, the Fed tries to optimize the level of interest rates for the US economy, but its decisions have global implications, not least for emerging markets. As easing begins, policymakers across the emerging world are watching to see the impact on their economies. But will falling US rates change their behavior? Not necessarily. Shilan Shah and Lily Millard from our EM team have been looking at what Fed easing could mean for EM central banks, and they've come up with some notable conclusions. They spoke about their work earlier this week, and here's that conversation now, beginning with Lily talking about how Fed policy affects these economies.
One of the main channels that Fed policy will affect emerging markets is via capital flows. For economies that have very open capital accounts or pegs to the dollar like Gulf countries, they'll automatically follow the Fed in order to maintain a constant interest rate differential. Central banks in Mexico and Indonesia place quite a lot of weight on Fed decisions because of the impact on their capital flows and their currencies. As it happens, Indonesia cut on the same day as the Fed this week in anticipation of the Fed beginning its easing cycle. Domestic financing conditions will therefore ease in all of these economies. However, it's a bit of a misconception that the Fed has a massive impact on a lot of these EMs, and broadly, the impact of the Fed can be overstated.
Yes, I think that's right. It does tend to be that domestic factors matter a lot more to emerging markets policymakers now than perhaps was the case a couple of decades ago. Now, admittedly, policymakers in parts of Asia are likely to begin easing monetary conditions in the next couple of months or so. Lily, you already mentioned the rate cut in Indonesia this week. But I think the upcoming decisions in places like Korea, Thailand, and the Philippines probably have more to do with low domestic inflation and growth concerns rather than what's happening to monetary policy abroad. And if we look elsewhere, so outside of Asia, emerging market easing cycles have been pretty detached from those in developed markets and in particular the Fed. So some central banks in Latin America and Central Europe, so Brazil, Chile, and Hungary come to mind. They all started to cut interest rates well in advance of the Fed, some over a year ago now. And in fact, their easing cycles have progressed to the point that they're entering the slower phase now. And actually, it's notable that Brazil's central bank hiked interest rates on the same day that the Fed cut interest rates this week, partly to shore up its credibility, but also because of growing inflation concerns.
Perhaps if we look away from monetary policy, though, there may be benefits from EMs that are struggling with balance of payments problems. Shifting rate differentials against the US dollar mean that we expect the DXY index to weaken a little bit further next year. Historically, this has created an environment that's seen foreign capital inflows to EMs pick up.
Yeah, that's right. I think the countries that stand to benefit most are those with large external financing requirements. That's a slightly jargony way of putting it. Essentially, what I mean by that is the amount of inflows that are required in the next year in order to finance current account deficits and external debts. In general, the major emerging markets' dependence on foreign capital flows is quite low. So in that sense, Fed easing might not prove to be the boon that it once might have been. But there are still some pockets of weakness when we look at external financing requirements, in particular in the likes of Argentina and Turkey. So, yeah, there will be some welcome respite for policymakers in those countries.
I guess the last area that it's worth looking at is the trade angle. A weaker dollar will obviously harm exports for those countries who are heavily reliant on the US market, like maybe Mexico and much of Southeast Asia. But this period of Fed easing looks different to many other periods of Fed easing in the past because US consumption, including imports, are holding up a lot better, and our base case is still for a soft landing in the US. So this time, a weaker dollar may be only a small headwind to emerging markets.
Yeah, I think that sounds about right. That being said, there are other, perhaps more significant headwinds facing the emerging world at the moment. That includes signs of China's economy slowing once more, also fiscal policy and monetary policy still remaining quite tight across the emerging world. Now, of course, monetary policy may now start to ease more broadly, as we've mentioned, but there is still some drag from quite tight fiscal policy. All of this means that the outlook for the emerging world over the coming quarters is perhaps weaker than it was in the first half of this year.
That was Shilan Shah and Lily Millard talking the Fed and EMs. You can stay on top of the FX, bank and sovereign risks facing emerging markets with our proprietary EM financial risk indicators. There's an interactive dashboard with underlying data that can be exported into your workflow, and I will link to it in the podcast notes along with Lily and Shilan's report. Those indicators are just one of the many interactive dashboards available to CE Advanced clients. Find out more about how our data can help you at capitaleconomics.com/data. But that's it for this week. We will be back again next week with the latest analysis of global macro and markets. Until then, goodbye. Whilst this podcast is provided with all reasonable skill and care, it comprises the subjective views of our economists. Furthermore, these views are not opinions, nor do they constitute investment or financial advice, or are they guarantees or reassurances to the expected results of any investment products or outcome. You should seek your own specific advice in relation to questions you may have. We will have no liability to you in relation to this podcast whatsoever.